Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Today we're joined by Lucas Porbeau from Lonsec. He's an investment guru that works at Lonsec, looking after all things about the market, an economist. So we've got a few questions to run through with Lucas about what's happening in the world, the share markets, and investment portfolios across the board. So thanks for joining us today, Lucas.
I'm also interested, because you mentioned demand there and the interest rates are having an impact on demand. You also mentioned earlier on about households, fixed rates potentially coming off within the next year or two, and then they'll get that real big jump from a pretty low fixed rate to 4 or 5% or whatever their variable rate at their bank would be. Something I come across the other day was a stat sort of comparing Australia's fixed rates to the US. Now, in the US, a very different system. They can fix rates for 30 years. And the stat was that something like 15% of households in the US are on a variable rate, okay? And the rest of them are fixed, whereas in Australia, it's very, very different, because we can't fix for that long. And so with our Reserve Bank putting up rates, it can have a much bigger impact on household spending as opposed to the US. So I'm just wondering what your view is in terms of how far, say, the US might have to push as opposed to Australia, because the US Reserve Bank seems to want to almost send their country in a recession. That's almost what it seems like. How fast they're increasing rates, and also what that does as a supplementary to differences in exchange rates in terms of how that can affect other countries like Australia. Yeah,
so you're right. The variable fixed dynamic is very different. So Australia is much more sensitive, to the interest rate. The households are much more sensitive to the interest rate cycle, given the high percentage of variable rates, so 100%. I think in the US, one of the differences is you've seen that core inflation figure go up as well. So it's probably fair to say that the inflationary pressures are much, certainly stronger, I'd say, compared to Australia in terms of where we're at the moment. But you have definitely seen a strengthening dollar, US dollar on the back of that as well. So, the implications are, it depends on the economy. Certainly on the emerging market economies, they're much more sensitive to that, and that's going to probably hurt them more in terms of the rising dollar. I mean, the Aussie dollar's been depreciating, obviously, over the last sort of period as well. So, I think I think the main point is, there's, if you sort of break down the world, there's probably different sort of contributors to inflation, different levels of inflation that you'll probably see in different ways central banks will respond. But certainly if you look at the Fed, I think that the narrative is much more that if a recession happens, so be it. I think they're very much on that sort of, we're just going to keep on going until we see we sort of see that slow down. So, but in Australia, it's yes, we are, as I mentioned before, we're seeing the similar pressures, but it's probably not to the same extent as some parts overseas that we're seeing. But the interest rates, look, the variable interest rates in terms of households, if anything, that's going to have a bigger impact here and slow down demand quicker, because people are going to feel it.
Arguably, the US Fed, in my mind, has to push rates a bit higher because the impact of the rate rises maybe aren't flowing through like they would in Australia, because households are mostly fixed.
Yeah, yeah, it's a different, absolutely, it's a different construct. Yeah.